Valens Research, Uniform Financial Analytics.
DaVita is specifically, it is a dialysis company, for lack of a better word. They help people who have critical renal issues, right? Critical kidney issues, filter their blood, right? That's essentially what DaVita does. And so, right, when you think about that, their real core business is a leasing business. They lease out their equipment to be able to use, right, for dialysis. Sometimes it's in their own facilities, if you will. Sometimes it's at home. Sometimes other facilities use it. But many people would say, oh, it's a leasing business. Well, no wonder, as the as-reported accounting metrics show, this is a 6% as-reported ROA business. But when we make all the uniform accounting adjustments, we see something very different. And before I jump into what we see, let me actually just walk you through how to read these charts. Because whenever you come into the Valens Research app and look at an individual company, you're going to see the first page you always land on is the PVP chart, or the performance and valuation prime chart. What this chart shows you is literally, you can see, as we talk about with uniform accounting, et cetera, we're very literal people here at Valens. Performance and valuation prime, why do we call it that? Because it highlights the company's performance and what the market's valuing the company to do. So the first chart here, as I highlighted already, we're talking about the as reported orange bars here for ROA, is the return on assets, the real return of a business. We show first and foremost the as reported GAAP accounting distorted ROA of a business for the last 15 years. And then we also showed these blue bars, the true blue uniform accounting of what the real corporate profitability of DaVita is. You can see here, one of the big things that we're highlighting for DaVita, which is so important, is this is not a 6% cost of capital leasing business. This is a business that actually offers significant value add, which is why return on assets is actually 2 times as high as the as reported metric would tell you. Even though it's declined in the last 3 years after the company divested some assets to United Healthcare, et cetera, it is starting to recover again and it remains robust. But looking at historic ROA alone isn't enough. We also look at asset growth. And by the way, just so you know, I'm not ignoring these 5 bars. I'm going to actually come back to them in a moment. We also look at the company's asset growth. How much is the company reinvesting in the business? Right? You can see again, we've got the orange distorted as reported metrics, and we've got the true blue uniform accounting metrics. Here, what's really telling is, look for the last 3 years, right? As reported metrics would say that assets were basically flat for 2 years and then shrunk in the last year. In reality, DaVita has been growing each of those years. If you were analyzing DaVita using as reported accounting, you would think you have a low return shrinking business. In reality, you have a high return recovering growing business. Those are 2 different companies to evaluate, 2 companies that deserve different valuation multiples, 2 companies that deserve different questions for management and for analysts about what's going on in the business, and different kinds of modeling, right? Fundamentally different kinds of insights you see from the distorted as reported metrics and the uniform accounting metrics. The next chart is VA prime. VA prime we also call our uniform price to book metric, meaning what we're looking at is what is the price to book assets enterprise value, which is why EV, VA, to our adjusted assets. What we're looking for here is a very strong relationship between a company's multiple it trades at relative to its asset base, once you remove all the accounting noise, and how high a company's return is. Just intuitively, if you think about it, a company that has a return that's around its quote unquote cost of capital, investors' cost of capital, right around 5% right now on a real basis, should trade at about 1 times assets. I, as an investor, need a 5% return. You, as a company, are producing a 5% return. I pay 1 times book. If you are producing a 10% return and my cost of capital is 5%, if I need to basically, so investors will then bid up the value of your company relative to its asset base until it's 2 times its asset base, right? If I need a 5% return and you're generating a 10% return, I can pay up to 2 times the value of your assets and still get a 5% return or better. So what we pay attention to here is there's a very strong relationship between VA and ROA. You can even see here, right, as ROA rose, VA rose, as ROA fell, VA falls. And we can actually understand that to see when we're seeing mispricing. We look at the same thing for our VE prime. Our VE prime is just like our VA is price to book. It is our cleaned up price to earnings ratio, our cleaned up PE. You can see it relative to the as reported PE too. And the last thing that we look at is what we call TSRR. For those of you who don't know, TSR stands for total shareholder return. Total shareholder return means what is the combined capital appreciation and income a stock generates for investors. The second R, the little r there, is relative. Relative to what? Relative to the market. In this case, because it's a US listed name, relative to the S&P 500, the most widely followed benchmark in the US. What you're looking at here is when this is flat year over year, that means the company performed in line with the market. When it's rising, that means the company outperformed the market, right? Just like here. When it's falling, like it did for many of these years, you see that is because of the fact that the company underperformed the market. What we often see is there's an incredibly strong relationship between the uniform accounting returns and asset growth for a company and its TSR in a way that there is not at all when you look at the distorted as reported metrics. You can even see it here, right? ROA on an as reported basis has been declining almost every single year and really peaked in basically 2011 before falling off. Well, ROA rose here and the company continued to invest. You can see TSR rose until ROA peaked, and then TSR declined as ROA started to decline, and now TSR is recovering again as the company is both returning, is both improving its returns and also finally reinvesting in the business. But as I mentioned, understanding the history is not enough. That's where these bars come in, which are incredibly powerful. What these 5 bars are looking into the future. We know what the historic profitability of DaVita is. What these 2 light blue bars are what the analysts, sell-side Wall Street analysts, are pricing the company to do once we take their estimates for things like earnings, revenue, CapEx, and we put them through the uniform accounting framework. So analysts are forecasting ROA that has started to recover from 2018 to 2019 to recover further in 2020 and then moderate in 2021. Also, analysts are forecasting a slight shrink in the company's asset base. These white bars are what the market at a $10 billion market cap for DaVita and an $81 stock price, this is what the market is pricing DaVita to do. So if DaVita can do better than growing its assets at 4% a year and seeing returns fall back to 12%, which is basically where they were in 2018, historic lows, if DaVita can do better than that, DaVita is undervalued. It could actually potentially see upside. Now, we just rolled out an improvement to our Better Expectation tool, so I'm going to see if I can actually use this to highlight for you how it works. It's still, since we're rolling out an improvement, I just want to make sure that it actually works. But let's say that I think the company is going to grow at 3.5%, but I also think returns are going to stabilize back for DaVita up at 18%. I do calculate after I hit the output, and I see what kicks out. What I'm likely going to see is that this company isn't, okay, so right now it's actually, oh no, there you go. So what I can see is if it returns to those levels, this company is a double. This company is not worth $10 billion. This company is worth $20 billion from market cap perspective because of how robust the returns are for the business with continued steady growth. Right? This is the power of what we can do with uniform accounting is once we understand what the company's historic profitability really is, once we see through the distorted as reported metrics, once we can understand what analysts are forecasting, and most importantly, once we can understand what the market's pricing in, we can have a far faster conversation about whether or not we think a company is undervalued or overvalued. Right? One of the things that we always focus on here and why we call this tool the Embedded Expectations Analysis tool is because of the fact that we understand that all the investment grades don't first focus on what they think a company is worth. They focus on what the market thinks a company is worth. Because if I can understand that the market already expected DaVita's returns to be flat, and I thought DaVita could return to normal profitability levels, well, then there's nothing for me to do here. DaVita looks fairly valued. But with this one, DaVita actually looks cheap once we see through the as reported distorted analysis, because what we can see is the market thinking this is a low return shrinking business is pricing it to continue to be a low return shrinking business when in reality it's anything but.
Valens Research, the world's leading source for uniform financial analytics.